Hi guys, today we are meeting through a recorded session. So if you have any questions, unfortunately you might not be able to clarify them today itself, but you can ask at the next class when we meet live. Right? I'm not sure whether you all can hear me. Kavindu, are you there? Hello? Right, so I have confirmation that you all can hear me. Let's get going. Right, so today we will focus on some financial instruments called derivatives. Right, so now derivatives are very risky instruments if you don't know what you're dealing with. Right, well, actually anything in finance is very risky if you don't know what you're getting into. Right, whether it's a simple purchase of a bond or a share, if you don't understand the product, it's very risky. Right, so it's very important that you study whatever you're investing in or what you are dealing with. Right, otherwise it's going to be a big mess. Because there are so many examples where either there's been lots of financial losses or some sort of a reputational damage when dealing in derivatives. Right, there are many examples. Like the classic case, I mean, in Sri Lanka, there are some examples. Right, for example, you take a few years ago, about 7-8 years ago, CPC was looking to hedge their oil price risk. So they got into what are called options. Right? Now, eventually they ended up with huge losses, thundering losses, as well as several lawsuits because they could not, they incurred huge losses, and these losses they could not settle at the time. They refused to settle. So there were court proceedings, not only locally, but even overseas. Right? So that didn't go down too well eventually. But having said that, derivatives can be used for good use as well. You can manage your risk using derivatives, right? Now, not only in Sri Lanka, right? There are so many examples where derivatives have gone wrong. Even the subprime mortgage crisis, which happened in 2008 in the US, was also a direct result of derivatives. Right, so the subprime mortgage crisis is where there was a bubble in the US housing market, and most of the banks were lending aggressively because interest rates in the market were very low. And there was nothing much to do for banks but to take more and more risk. So if customers did not have capacity to repay, they didn't have assets to repay, banks were still willing to lend, right? So that was called predatory lending. Now, when banks were doing predatory lending, more and more people started taking loans at very low interest rates and on a floating rate basis, right? So gradually interest rates in the US started going up. Now, when your loan is priced or structured as a floating rate loan and interest rates start going up, your debt service cost will increase because the variable component will go up, right? So lots of guys found it very difficult to settle. Remember, they were subprime customers, they were not the prime customers. So settling these obligations became an issue, and there were defaults. When a housing loan default, we know that the bank will take over the property and sell it off, right? So there were so much of sales coming up. Banks actually got into property business. Right? They got landed with so many real estate properties, which they found it very difficult to settle because everyone was defaulting on their loans. Even genuine customers were defaulting on loans because what happened was, with low interest rates being there, everybody started taking these interest loans and investing in property, right? So the property prices started going up. Now, when banks find property prices going up, they are happy to lend because the security that they take will always increase in value, right? So there is always an incentive for the will have an asset which is worth more than right. Because let's say, for example, $100,000 loan, right? If your loan amount is 100,000, your property will be worth, let's say, 150,000. So the property price keeps going up. Let's say it hits 200,000. What do you think will happen now that we have several guys online? What do you think will happen if the value of the security keeps going up? Will customers default, or will they continue servicing the loan? What is likely to happen? If the value of the security keeps going up, what is likely to happen? Do you think there will be defaults on loans, or are customers likely to keep servicing their loans obligations? Yeah. If the value of the property keeps going up, they definitely will settle your service your obligations. Then it doesn't make sense to default, no? Because if you default, you will forego a property or an asset which is worth, your loan is worth 100,000 and your asset value increases to 200,000, right? So it makes sense to settle the facility. But if the opposite happens, right, you have 100,000 loan and the property was initially valued at 150,000, but over a period of time it drops to $50,000, right? So your obligation is 100,000, but your asset is now worth only 50,000. So by settling a facility which is worth $100,000, you will get an asset which is worth $50,000. Right? It doesn't make sense to service it. Right? So that is when customers will default. I hope that is clear. Now that is what happened in the subprime mortgage crisis, because all the banks got landed with property which they had to sell because there was no other cash flows coming in. Right? So to maintain the liquidity, the banks had no choice but to sell the properties, foreclose the property. So there was liquidity in the banking system in the US dried up. Right? So banks were forced to keep selling the properties. That's why the property market in the US collapsed. Subprime mortgage crisis, right? This happened because of collateralized debt obligations or credit default swaps. Now, swaps we will touch base today. So remember, Warren Buffett actually said that derivatives are financial weapons of mass destruction, right? So if you don't know the product, it's very, very risky. Don't just blindly jump into it, right? So having said that, let's start off with futures contracts. Futures are not complicated products, right? Now, it's to trade on futures, you have to be registered with a futures exchange. Otherwise, you can't trade. Now, the best example I can give you is if you want to choice, CD, right? House. Then when you trade futures, you can't customize it, right? For your needs, you can't do it because all these futures contracts are standardized. Yeah, but in the stock market again, for example, if you buy a share, let's say, for example, I'm just picking names. Say you bought John Keels. You can't buy 1.5 shares of John Keels, or you can't buy 10.5 shares of John Keels. You can't even sell 2.5 shares of John Keels. You can't. You have to buy either one share or you have to buy 2 shares. You can't buy in between, which means you can't customize. But if you want to buy, let's say, meat, right? You want to buy chicken. You can buy 1.5 kilos of chicken if you want, or you can buy 1.5 loaves of bread. You can customize, right? So there are two different markets. One market you can customize, other market you cannot, right? So the market where you cannot customize is called standardized. All the products which trade on futures are standardized. Now, again, take the John Keels example. if I buy John Keel's and if you buy John Keel's shares, the same thing. Right? The John Keel share that I have the same features that the John Keel shares that you have. There's absolutely no difference. So likewise, futures also the same product. You cannot standardize. Right? Very important point. Remember these points. And then futures trade on an exchange, and these are obligations. Right? Something like getting married. There is no turning back. I mean, if you agree, you have to go ahead with it. Right? Right. In a way, it's similar to forward contract. Right. So that's what the first sentence says. It's well, the difference between the forward and the future is that forwards can be standardized, whereas futures cannot be standardized. Right. So the main difference. So remember that a forward contract is an agreement made today between a buyer and a seller who are obligated to complete a transaction at a date in the future. The buyer and the seller know each other. Right. In a forward contract, you know the buyer and the seller. Now, take for example a forward exchange rate, right, which we discussed a few weeks back. Now, the customer goes to the bank and deals directly with the bank, right? So you know the buyer who you know the seller. They are known to each other. Unlike in a futures contract where you don't see names, right? When you go to the stock market, you don't see who is buying and who is selling. You only see the volumes that are being traded, right? The bids and offers and the prices. So the same thing applies in the futures market as well. A forward contract is an agreement made today between a buyer and a seller who are obligated to complete the transaction at a date in the future. The buyer and the seller know each other. The negotiation process leads to customized agreements. What to trade, where to trade, when to trade, how much to trade, all can be customized. Right? The price at which trade will occur is also determined when the agreement is made. This is known as a forward price. So that is similar to futures also. The price in that case is called a futures price. One party faces default risk because the other party might have an incentive to default on the contract. Right? So it's always the party which is making a profit that is exposed to default risk. Okay, because the other guy is anyway losing. If he defaults, he can save his loss. So there is some incentive for him to default. But if you are at a profit and the other guy defaults, then you're not at a risk. If you are at making a profit and the other person defaults, right? The risk of default is on you. You are carrying the risk of default. Whereas in futures contracts, now if you buy shares, you're guaranteed. If you buy a share, guaranteed that you will get the share, right? And likewise, if you sell a share, guaranteed that you will receive the money also. There is no doubt because the exchange guarantees settlement. Futures the same. Exchange guarantees the settlement. So there is no settlement risk. To cancel the contract, both parties must agree. One side might have to make a dollar payment to the other to get the other side to agree to cancel the contract. Let's say if you want to cancel this contract, whatever that is lost, right, will have to be paid by the person losing to the party that is making a profit. Right now, let's say, for example, I have bought, just for example, let's say I have bought a mango, and I want it in 1 month's time, 31st December, I want it. Now, I have agreed to buy it on 31st December at a price, let's say, of 200 rupees. Today, the market price of a mango is 100 rupees, right? 31st December. Let's say there's a forward market for mangoes, so I agreed to buy at 200 rupees. Now, on 31st December, if the price of a mango in the market is 150 rupees, that means I have lost, right? I have lost 50 rupees. If I want to cancel this contract somewhere in between, then I have to pay the 50 rupees to the seller. That's how you cancel a contract. The losing party has to pay the party that is making profit. Okay, so now we move on to futures contracts. A futures contract is an agreement made today between a buyer and a seller who are obligated to complete a transaction at a date in the future. The buyer and the seller do not know each other. Right? They don't know each other. They can't see each other. The negotiation occurs in the fast frenzy of a futures pit. Futures transactions, remember, happen in the futures pit. If you had watched Rogue Trader, you will know what a futures pit is, right? Because Nick Leeson, if you all could recall, you will see that he trades in the pit. Right now, when you trade in the pit, it's very noisy. Lots of people keep shouting on either side, and in between, only you trade. The terms of a futures contract are standardized. Very important point. Remember, futures are standardized. What to trade, where to trade, when to trade, how much to trade, what quality of goods to trade, all standardized under the terms of the futures contract. Financial futures are usually cash settled, although physical delivery is not impossible. Cash settlement, remember that mango example I explained? If it's cash settled, I have to pay 50 rupees to the party that is making profit, right? If I'm losing 50 rupees or whatever the difference between my agreed buying price and the market price. Physical delivery means I might actually get a mango, which is worth 150 rupees, right? Whereas I have agreed to buy it at 200 rupees, right? So that's now if I sell this mango at that point, I have paid 200, I receive 150, so I make a 50 rupee loss, right? So it comes to the same thing: cash delivery, physical delivery or cash settled. The price at which the trade will occur is determined in the pit. This is known as the futures price. No one faces default risk even if the other party has an incentive to default on the contract. Right? So remember, futures have no risk of default. The futures exchange where the contract is traded guarantees each trade and no default is possible. To cancel the contract, an offsetting trade is made in the pit. The trader of a futures contract may experience a gain or a loss. And so this is a little bit of history on futures. When time permits, just go through. Right, I will skip them. In general, futures contracts must stipulate at least the following 5 terms: the identity of the underlying commodity or financial instrument. You have to specifically mention what you're trading, maybe crude oil, right? So if it's crude oil, then you have to give the sulfur percentage, the delivery port, delivery date, and all that. Futures contract size. So if it's crude oil, you need to say how many lots you're buying. A lot is 1,000 barrels of crude oil. The futures maturity date, also called the expiry date. Right? What is the settlement date? The delivery or settlement procedure, whether it's cash delivered or physical settled. And the futures price. Right, so these are some of the futures contracts that are there in the market, right? So, well, actually, you can structure futures on anything under the sun. Even the weather can be structured into a futures contract. They're called weather futures. So there are grain, oilseed, petroleum futures, heating oil, natural gas, soybean. Right, under grain, you have so many stuff: corn, oats, soybeans, soybean oil, wheat. The petroleum futures, crude oil, heating oil, gasoline, natural gas. You can have interstate futures, treasury bonds, right? Index futures like the Dow Jones, S&P, and all that. Metal futures, copper, gold, platinum, currency futures, right? All sorts of currencies. Okay, so that's only for information. Right. Next important question is why futures? A futures contract represents a zero-sum game between a buyer and a seller, which means if there is a buyer and a seller, right? I agree to buy. Remember that mango example again. At 31st December, I agree to buy mangoes at 200 rupees. If the price on 31st December is 150 in the market, I will lose 50 rupees, right? I will lose 50 rupees. The person who is selling will gain 50 rupees. So if you add the 50 rupee profit and the 50 rupee loss, zero sum. That's called a zero sum gain. Gains realized by the buyer are offset by losses realized by the seller. The futures exchange keeps track of gains and losses on every day, gains and losses every day. Right. So remember, futures contracts are marked to market on a daily basis. That means you calculate the profit or the loss on a daily basis. Futures contracts are used for hedging and speculation. Right? Hedging means to manage your risk. Speculate means you take on risk. Hedging and speculating are complementary activities. Hedgers shift price risk to speculators, and speculators absorb price risk. Okay. So remember, hedgers or the persons who don't want to carry risk or want to carry minimum risk will transfer the price risk to speculators. Buying a futures contract is often referred to as going long or establishing a long position. Each futures contract has an expiry date. Every day before expiry, a new futures price is established. Okay, so every day it's being marked to market. That's the most important point. Buying is called going long, right? So if you buy anything, that means you are going long. For example, let me see. If you buy this phone, it means you are gone long a phone, right? This phone, if you sell, it means I'll come back to that later, right? So going long means buying. Remember that. Every day before expiry, a new futures price is established. If this new price is higher than the previous day's price, that means if the price goes up, the holder of a long futures contract position profits from its futures price increase. If this new price is lower than the previous day's price, the holder of a long futures contract loses from this futures price increase. So if you buy this phone, let's say for 1,000 rupees, and the next day the price goes to 1,200, that means you will make a profit. But if you buy it for 1,000 rupees, the next day the price goes to 800, you will lose. Right? So if you go long, your risk is the price going down. That you need to remember. Let's try this example. Speculating in gold futures. So let's go through it. You believe the price of gold will go up. Right? So if you feel the price of gold is going up, the most logical thing you need to do is you need to buy it. Right now, for example, if you feel prices of let's say vehicles, right, will go up further, you will jump and buy whatever the vehicle that is available today itself, isn't it? So if prices are going up, you will buy vehicles. But if prices you feel are going down, you will sell whatever the vehicle you have so that you can buy it back later on. Okay. Okay, so you believe the price of gold will go up. So you go long 100 futures contracts that expires in 3 months. The futures price today is $400 per ounce. There are 100 ounces of gold in each futures contract. Right. So your position is valued at an ounce is valued at $400. You're buying 100 ounces, right? And 100 futures contracts. Sorry, well, ounce is valued at $400 per ounce, right? You're buying 100 contracts, and each contract has 100 ounces. So your position is valued at $4 million. So if your belief is correct and the price of gold is 420 when the contract expires, that means the price of gold has increased from 400 to 420. Right? You bought at 400, the price has gone up to 420, you make a profit. A $20 profit, right? Because 420 minus 400 is $20 profit. You have 100 contracts, each contract has 100 ounces. So your profit will be $20 profit into 100 into 100, right? That's about $200,000. But if the price drops to 370, then what happens? Right. So you bought it at $400. And the price drops to 370. Right? So you'll have to sell it at $370 minus the purchase price of $100. You have 100 contracts. Each contract has 100 ounces. You make a $300,000 loss. Let's move on. Then going short. Right? Now, I earlier explained that if you buy this phone, you have gone long. So my question is, if you sell this, the same phone, if you sell, is that going short? The answer is no. Right? You are selling an asset which you already have. That's not short. Short means you don't have a phone, right? But you sell a phone. You agree to sell a phone, right? You don't have a phone, but you are to sell. Then you are short. You have sold an asset which you don't own. It's called going short. Now, why would you sell an asset which you do not own? The answer is you expect the price to drop, right? Now, let's say you have agreed to sell a phone similar to the one that I just showed for, let's say, 100,000 rupees, right? Now, if the price, well, maybe on 31st December, right? You agree to sell it by 31st December. If that price, if you don't have that phone, you will have to buy it back, and you are agreed to sell it at 100,000. So if you buy it back at 110,000, you will lose. Now you will sell it short. You go short. You do short sell because you expect the price to go down. Right? Yeah. On 31st December, if the price drops to 80,000, you can buy it at 80,000, but you have agreed to sell it at 100,000. But by any chance, if the price has gone up to 110,000, you will lose. Right? So remember, short selling means selling an asset which you do not own. When you short sell, you expect the market price to come down. Okay, so the risk is the price going up. Each futures contract has an expiry date. Every day before expiry, a new futures price is established. This is called marking to market. Right? All futures contracts are marked to market. If this new price is higher than previous day's price, the holder of a short futures contract will lose from this futures price increase. If this futures price is lower than the previous day's price, the holder of a short futures contract profits from this futures price decrease. Right, so let's go through this. You believe the price of gold will go down. Right, so if you expect the price to drop, the best thing to do is to short sell. So you go 100 short 100 futures contracts that expires in 3 months. The futures price today is $400 per ounce. There are 100 ounces of gold in each futures contract. Right, so your position is valued at $4 million. Simple. No? Suppose you believe correct, your belief is correct, and the price of gold is 370 when the futures contract expires. Right? So you can buy it back at $3.7 million. Okay, you sold at $4 million. Now you are buying to buy it back at $3.7 million. So the difference between your selling price and your buying price is $300,000 plus. So you make a $300,000 gain. But if the price goes up to $420, you have to buy it at $4.2 million, whereas you received only $4 million, right? So if that's the case, you will lose $200,000. That's how futures works. Hedging with futures, a hedger trades futures contracts to transfer price risk. And remember, he wants to transfer the risk. He doesn't want to take on risk. Hedgers transfer price risk by adding a futures contract position that is opposite of an existing position in the commodity or financial instrument. When the hedge is in place, the futures contract throws off cash when cash is needed. The futures contract absorbs cash when cash is available. Right? We will do an example so that you will understand better. A company has a large inventory that will be sold at a future date. So the company will suffer losses if the value of the inventory falls. Suppose the company wants to protect the value of the inventory. Selling futures contracts today offsets potential declines in the value of the inventory. The act of selling futures contracts to protect them is called short hedging. I remember the earlier. Okay, let's try this example. Suppose Starbucks has an inventory of about 950,000 pounds of coffee, valued at 57 cents per pound. Starbucks fears that the price of coffee will fall in the short run and wants to protect the value of its inventory. How best can they do this? There is a coffee futures contract in the New York Board of Trade. Each contract is for 37,500 pounds of coffee. Coffee futures prices with 3 months expiries, 58 cents per pound. Selling futures contracts provides inventory price protection. Right. So let's see how this can be done. Let us work this out on an Excel sheet. If they buy 950,000 pounds at 57 cents, there will be a dollar outflow of 541,500, right? Now, they have purchased coffee inventories at a price of 57 cents per ounce, right? So if by any chance the price of coffee falls from 57 cents to maybe 50 cents, Starbucks will lose, right? So to hedge this risk, what they can do is they need to purchase, sorry, no, they need to invest in a futures contract which makes a profit if the price goes down, right? That's what you need to understand. They need to use a derivative which makes them money if the price goes down, because their risk is the price going down, right? So they need something which makes them a profit if the price goes down. Now, if you could remember what we discussed a few minutes back, the only way to make money when the price goes down is to short sell, right? What they do is there is, that question says there is a coffee futures contract at New York Board of Trade. Each contract is for 37,500 pounds of coffee, right? So their exposure is 950,000 pounds. So the number of contracts be 950,000 divided by 37,500. 25. Let's say they short sell 25 futures. They're short selling 25 contracts, each has 37,500. Short sell means they are going minus at a price of 8 cents. Now, when you sell, you will receive the dollars. You will receive $543,750. Right? So let's keep reading this. "25 futures contracts covers 937,500 pounds, and 26 contracts covers 975,500 pounds. So they can either choose between 25 and 23, but either way they will end up with 937,500 or 975,000. But they can't match it exactly with the 950,000, right? So because like we discussed earlier, they are dealing in futures contracts which are standardized. You can't do something in between, right? So Starbucks decided to sell 25 near-term futures contracts. Over the next month, the price of coffee falls, right? So if the price falls, remember their risk is the price coming down. The value of inventory will also fall. Starbucks sells the inventory for 51 cents per pound. The futures price also falls to 52 cents. They bought it at inventory was purchased at 57 cents. Price has dropped to 52 cents. 1 cent, sorry. And futures were sold at 58 cents and the price drops to 52 cents. Question is, how did this hedge perform? So let's see. Go back to the Excel sheet. This is what happens today, and then in 1 month, see what has happened. Inventory is down to 51 cents. And futures down to 52 cents, right? So at the end of 1 month, they need to sell, let's say they are selling their inventory in 1 month, but the price is down to 51 cents. And the futures position, they will have to buy back, right? So what happens is eventually, after 1 month, they have sold coffee, they're left with no coffee, and futures they have bought back. And so there are no futures contracts outstanding also, meaning they're totally in a squared position, right? So if you look at the profit or the loss, this will be they lose $57,000 because of the drop in futures price, isn't it? And futures, they will make a profit of 56,250, right? So the net would be 750. Okay. Which you will get even if you add up these cells. right? Because see, on day one, they have purchased inventory, sold futures, so they are left with 2,250 plus. And in 1 month, they are selling their inventory and buying back futures, so they will be left with 3,000 minus. The net is plus of $750. Okay. Now, if not for the futures contracts, not for this, remember Starbucks would have lost $57,000. But because of futures contracts, they saved $56,250 and end up with a loss of $750, which is pretty good. Good going. Yeah. So I hope that is clear. Meaning the hedge has saved them $56,250. If this wasn't there, they would have lost $57,000. Okay, so pretty good hedge in the end. At the same time, let's see what will happen if the prices had gone up. Right? On the previous example, the price of inventory as well as futures came down. What will happen if the price of futures had gone up? Let's say 57 cents had gone up to by 6 cents each, 63 cents. And 58 cents had gone up to 64 cents. Now, the price of inventory going up should have made them a profit, but they went short. Remember, the risk is when you go short, price going up. So on futures, they made a loss and end up with a profit of only $750, right? Whereas they could have made $7,000. But this is the problem when you hedge, right? If you keep your positions open or naked, you will you will make bigger gains or bigger losses if your positions are open, which is called a naked position. But if you hedge, you're mitigating your losses. At the same time, you will also lose the upside potential, right? So you will not gain big, not lose big, but pretty much at a neutral position. Okay, right. Let's get back to the next example. Long hedge, right? Long hedge means if your risk is the price going up, right? Your risk is the price going up, then you have to hedge yourself so that you will make a profit when the price goes up, right? So the only way to do it is to go long. The company will suffer, company needs to buy a commodity at a future date. The company will suffer losses if the price of the commodity increases before then. That is, they paid more than what they should have. Right? Suppose the company wants to fix the price that they will pay for the commodity. Buying futures contracts today offsets potential increases in the prices of the commodity. The act of buying futures contracts to protect them from rising prices is called long hedging. Suppose Nestle plans to purchase 750 metric tons of cocoa next month. Nestle fears that the price of cocoa will increase before they acquire the cocoa. So they want to fix the price it will pay for cocoa. How best to do this? There's a cocoa futures contract at the New York Board of Trade. Each contract has 10 metric tons of cocoa. The cocoa futures price with 3 months to expire is 1,440. Right, so your risk is the price going up. And if that is the case, you will have to buy cocoa at not 4,400, but perhaps at a higher price. So what you can do is you need to go long futures. Right, so let's work it out on the Excel sheet. Sorry. Right, so exposure is 750 metric tons of cocoa, and each contract has 10 metric tons of cocoa, right? So that means very easily you need 75 metric tons, and you have a perfect hedge. Over the next month, the price of cocoa increases, and Nestle pays 1,490 per ton of cocoa. It used to be, remember, 1,400, but they end up paying 1,490. The futures price also increases to 1,525. Let's see how this hedge performed. $1,400. This is what they need to buy, but they haven't bought it so far. They have to buy, so let's put it as minus. And they haven't bought it yet. No. Now they have to buy cocoa. It's currently 1,400. And so the risk is the price going up. If it goes up, they will lose. So since they haven't bought it, they have $1,050 left with them. Right. 75 contracts priced at 1,440 per ton. Right. So they go long, 75 contracts, each has 10 metric tons, priced at 1,440. In 1 month, the price of cocoa has increased to 1,490. And the price of futures have also increased to 1,525, which they can now sell. Okay. The increase in price of cocoa has resulted in a loss of $67,500. But the increase in price of futures have saved them $63,750. Right? So their net is only a loss of $3,750, which is much better than a loss of $67,500, which would have been bigger. Okay. Right now, what will happen if the price had suddenly dropped? Let's say from 1,400 drops to 1,300, and from 1,440, let's say futures also drops by $100 to 1,340. The drop in price should have made a profit for you of $75,000, but you end up making a loss of $75,000, right? So you end up without any profit or a loss. That can also happen. But remember, when you hedge, you forego your upside as well as your downside. I hope that was clear. Right in the there's another part of the question. What would have happened if the price of cocoa fell by 85 and let's say the price of futures had gone down by 90? So let's see if the price of cocoa is not, sorry, 1 month, it's 3 months. Yeah, 1 month, sorry. Cocoa prices go down by 85. Futures price gone down by $90. Right, the drop in cocoa prices should have made a loss profit of 63,750, but the increase in futures should have made a loss of has made a loss of 67,500. So instead of making a profit of 63,750, you end up with a small loss of 3,750. And so you won't make big losses or profits, but you will more or less neutralize positions. All right, so let's move on. Futures trading accounts. Now, when you open futures, it's like opening a account in a bank, because you need a minimum deposit to open the account, which is called the initial margin in futures terms, and you have to maintain a minimum balance, which is called the maintenance margin. And then if your if your balance falls below the maintenance margin, you have to top up your balance up to the initial margin, which is called the difference between the initial margin and the amount that you have to top up is called the variation margin. Futures exchange, like a stock exchange, allows only exchange members to trade on the exchange. Exchange members may be firms or individuals trading for their own account, or they may be brokerage firms handling trades for customers. Important aspects of futures trading accounts. Margin is required, initial margin as well as maintenance margin. The contract values are marked to market on a daily basis, and a margin call will be issued if necessary, right? So if a balance falls below the maintenance margin, a margin call will be issued. Futures position can be closed out at any time. This is done by entering a reverse trade, because futures transactions, futures contracts are very liquid. That is unbelievable liquidity in the market. So you can do large quantities without moving markets. In the hedging example, Starbucks and Nestle enter trades. At the same time, they adjust inventories. In those examples, the futures contracts had 2 months left before expiry. Initial margin, which is a good faith deposit, is required when a futures position is first established. Right? It's like the initial deposit you place is called initial margin. It depends on the price volatility of the underlying asset and can differ by the type of trader. When the price of the underlying asset changes, the futures exchange adds or subtracts money from the trading account. This is called marking to market. When the balance in the trading account gets too low, it may violate the maintenance margin level, and a margin call is issued. Right? So if your balance falls below the maintenance margin, a margin call will be issued. There is a movie also by that name, Margin Call. Not super fan movie. Just watch it if you can. A margin call is simply a stern request by the broker that money needs to be deposited in the trading account. Right, so let's do this example. Says Martin opens an account with ABC Brokerage, and he believes the gold price will increase. Let's say, first question is, should he go long or short on gold futures? So if you believe the price will increase, the best thing you should do is to buy. But if you feel the price of vehicles will increase, you will buy. There are 100 ounces of gold in gold futures contracts. ABC requires an initial margin of $1,000 per contract and requires a maintenance margin of $750 per contract. Right? So initial margin $1,000, maintenance margin $750. Martin deposits $1,000 into his trading account. Let's again do the working on an Excel. He deposits $1,000 in his account. He has gone long. Initial margin is comfortably above his maintenance margin, and the question says, Let me take you to the question. Right on day one, he has purchased gold at $400. And the market closes at also 400. So your mark to market will be 400 This is the margin account opening balance. Let's calculate the margin account closing balance. We bought at 400, and if there's no change in price, bought at 400. If there is no change in price, we'll make a profit or loss. So your closing balance is equal to balance minus opening balance is 1000 minus the profit of 0. So you have $1,000. Okay. And A2, okay, yeah, the connectivity issue. Right, I'm back. Martin and question. Martin, the price 400, it comes to $200 loss. Right? That's what happens on day two. Day two, the price drops to his profit. $100 minus, which will be set off against his margin account balance, right? He starts with dollars and it will drop to $800. Now, $800 is still below the maintenance margin, right? So it doesn't have to drop. There is no margin call being issued. Let's go to day three and see what happens. Up further to 394. His account will close at $400. Right? This loss will be set off against his account balance, and he will have a closing balance of $400. Now, this $400 is below the maintenance margin, so there will be a margin call issued. And when the margin call is issued, the call will be issued on third day. He will have to top up his balance to $600. $600 need to be credited to the margin account. When $600 is credited, on day 4, he will open at $6,000, right? All right. Next question. On 1st March, ABC takes a long position of 10 May Treasury bond futures contract for the price of 105. One futures contract calls for delivery of 1,000 bonds. Thus, the initial futures price is $105,000 per contract. The initial margin requirement is set at 5% of the contract value, and the maintenance margin is 75% of initial margin. Right, so 5% of the contract value. Right. 1,000 bonds. Initial futures price is $105,000 per contract. Initial margin is 5% of the contract value. So let's see. Contract value is $105,000. 5% of that is $5,250 initial margin. And goes on to say that maintenance margin is 75% of initial margin. $3,937.5. So this guy is buying 10 contracts. Which is why the margin account initial margin is 10 times the 5,350, right? 52,500. Now on day one, if the price drops to 104, he will have $1,000 loss, right? Per contract, $1,000. So for 10 contracts, $10,000 loss, which will be set off against the margin balance of 52,500. Sorry, I'm not sharing the screen. If the price on day one drops to 104, each contract will carry a $1,000 loss. So on 10 contracts, he will have a $10,000 loss. Right? The $10,000 will be taken out against his margin account balance of 52,500. He ends up with $42,500. But there is no margin call because the maintenance margin is set at $39,375. Right, so the margin account balance should fall below $39,375. So there to be a margin call. Day two, the price drops by another $1,000, which is another $10,000 hit for 10 contracts. And the account balance falls to $32,500. There will be a margin call. And he will have to top up the account by $10,000 up to the initial margin of $52,500, right? That's $20,000. So the variation margin will be $20,000. Question number 3. It says a long position of 5 July beat contracts, each of which covers 5,000 bushels. Assume that the contract price is $2 and that each contract requires an initial margin deposit of $150 and a maintenance margin of $100. The total initial margin required for the 5 contracts is each $150 for 5 contracts, $750. The maintenance margin, each $100, 5 contracts, $500. Compute the margin balance for this question after 2-cent decrease in price on day one. Right? So day one, the contract price was $2 and the price drops by 2 cents. Day one, the price drops by 2 cents, meaning for 5,000 bushels, it's a $500 loss drop, right? So that $500 will be taken out against his initial margin of $750, right? And his account balance will drop to $250, which is below the maintenance margin, and a margin call will be issued. He has to deposit $500 into his account. The account balance will increase to $750. The next day, the price goes up by goes up to $1.99, right? So there is a $250 impact. That is because it's 5,000 bushels, 1 cent is $50, 5 contracts, $250 plus positive impact. And the account balance goes up to $1,000. So if it goes up to $1,000, you can bring it down up to the maintenance margin, right? If you want. Day three, another 1 cent drop, which is a loss of $250. The account balance again drops to $750. So that's how futures contracts work. Okay, so that's it on futures. Let's move on to swaps. In a swap, two counterparties agree to a contractual agreement wherein they exchange cash flows at periodic intervals. Notional principle is a reference amount used to calculate interest expense but never prepaid, right? Now, notional principle. Now, let's say you take a housing loan of 10 million. If annually the interest is calculated at 10%, every year you have to pay 1 million rupees of interest, right? So the calculation is based on the capital amount of 10 million. Now, that capital amount is called the notional capital, right? The notional amount. So all calculations are based on the notional amount. But in swaps, remember, the notional amount is never exchanged. There are two types of interest rate swaps: single currency interest rate swap and cross currency interest rate swap. Right? So you don't need to know these in detail, but just for your understanding, let's see how it works. Swaps can be used to hedge and can be viewed as a portfolio of futures with different maturities. Right. Let me explain in very layman terms. Yes. Oops. Let's say this is, and this is the bank, right? We'll assume that you are paying 10 million housing loan, an interest rate fixed at 10%, fixed interest of 10%, 10-year. Okay. So 10-year housing loan fixed at 10% interest. Now, if interest rates start dropping, you will not want to continue paying fixed rate. You will ideally want to pay a floating. If you feel interest rates will keep dropping, you might want to switch from fixed to floating, right? What you can do is you go to the same bank or maybe another bank which offers the facility, and you tell them your requirement. You tell them that you want to switch from paying fixed to paying floating, right? So what the bank will do is they will tell you to pay the bank let's say PLR, right? And the bank will tell on 10 million. Right? Now, all calculations are based on this 10 million, and that's called the notional amount. Of 10 million, in this case, the bank will tell you to pay PLR. And in turn, the bank will ask you to pay them PLR, right? In turn, the bank agrees to pay you a fixed rate of 8%. Right, so you're paying the bank PLR, and the bank will pay you a fixed rate of 8%. Now, if you look at the effective interest rates, right, on this one, you're paying 10% fixed, right? So let's put it as minus. Then on the second loan, on 10 million, again on 10 million notional, you will be paying PLR, but receiving 8%. Right, so if you take the net of this, it will be minus PLR. Minus,
I can't see the presentation.
oh, sorry. Good thing you are online. And I was happily doing this. Unfortunately, you didn't see it. Very, very sorry about that. Right, I'll explain again. Let's say you're paying a housing loan fixed rate of 10 years fixed rate at 10%, right? And you expect interest rates to drop. The capital amount is 10 million, which is the notional amount, right? You expect interest rates to drop, so you want to switch to ideally a floating rate because you expect interest rates to keep dropping. Now you go to another bank or the same bank and you tell the bank that you want to switch from floating to fixed. And so what the bank will tell is they will ask you to pay PLR. And the bank will agree to pay you 8%, both on this notional amount of 10 million, right? So on 10 million, you will pay the bank 10 PLR and the bank will pay you 8%. Now the original loan is also continuing, right? It doesn't stop. The net interest payment comes to PLR plus 2%. That will be your net payment. Now, originally, you're paying 10%, which is a fixed rate. And now you end up paying PLR plus 2%, which is floating. Right? So you have switched from paying fixed to paying floating, which is your original objective. Right? So that's called a fixed to floating interest rate swap. And if the opposite happens, right? Let's say you're paying PLR plus 2%. And you feel interest rates are going up, right? So ideally, you will want to switch from paying floating to paying fixed. Now you go to a bank, and you tell them that you want to switch from paying floating to paying fixed. So the bank will tell you to pay them a rate of 10%, right? And in turn, the bank will pay you PLR. Now, if you look at the net payment here on the original loan, you're paying minus PLR plus. Then the second agreement, you will receive PLR. You're paying 10%. Effectively, PLR cancels off and you end up paying minus 12%. It's a fixed rate, right? So originally you were paying PLR2, which is floating. Now you end up paying 12%, which is a fixed rate. So you have switched from floating to fixed interest rate, so IRS. Right, so let's continue with the slides. Bank A, right? This is plain vanilla interest rate swap. Now, interest rate swap, you use the same currency, but not two currencies, right? Or everything is quoted in the same currency. There is only one currency in use. Is a AAA rated international bank located in the UK and wishes to raise $10 million to finance floating rate Eurobond loans, Euro-dollar loans. Bank A issued 5-year fixed rate Euro-dollar bonds at 10%. However, it prefers to issue a floating rate note, maybe because it feels interest rates might drop. Then B is a BBB rated US company. It needs $10 million to finance an investment with a 5-year economic life, right? So Bank A also has 5-year requirement. B also has a 5-year requirement. And issues a floating rate note and LIBOR plus 0.5%. It, however, prefers to borrow 5 years fixed at a fixed rate. So borrowing opportunities are given here. B can borrow fixed at 11.75, floating LIBOR plus 0.5%. A can borrow fixed 10%, floating LIBOR. Right. So they want to switch their obligations from fixed to floating and floating to fixed. Swap banks makes this offer to A. You pay LIBOR minus 1/8 per year on $10 million for the 5 years, and we will pay you 10.38 on $10 million for 5 years, right? So swap bank will pay 10.38, and a bank A is supposed to pay LIBOR minus 1/8. Bank A can borrow externally. Position of the net interest will be 10.38 minus 10% minus LIBOR plus 1/8. Right? So 10.38 they're receiving, and the other two interest rates they're paying, which comes to LIBOR minus 0.5%. Right? LIBOR minus 0.5%. If you look at the borrowing sheet, is 0.5% better than but they can borrow on a floating rate. And they will save $50,000 of interest per year for 5 years. Then for B, right, they want to switch from paying floating to paying fixed. Makes this offer to B, you pay 10.5 per year, $10 million for 5 years, and we will pay you LIBOR minus 0.25% on $10 million for 5 years, right? So SoftBank will pay LIBOR minus 0.25% to B, and B will have to pay 10.5%. Right? They can borrow externally at LIBOR plus 0.5%. They're currently borrowing at LIBOR plus 0.5% and have a net borrowing position of 10.5 plus LIBOR plus half minus LIBOR minus quart, which is 11 quart. Still, they are 0.5% better off than the original borrowing rate. Right, so $50,000 again saved. SwapBank also makes some money of 0.25%. Right, if you take the net interest for SwapBank, they save about, they make a profit of about $25,000 every year. Right, so it's win-win for all. That's called currency swap. Sorry, an interest rate swap, single currency interest rate swap. Similar to what we discussed earlier, swapping from fixed rate to floating rate. Now, currency swap is slightly complicated, and this is only for your knowledge. Suppose a US multinational company wants to finance 10 million pounds as expansion of a British plant. They could borrow dollars in the US where they are well known in exchange for dollars for pounds. This will give an exchange risk, financing a sterling project with dollars, right? They could borrow pounds in the international bond market but pay a premium since they are not as well known abroad. So what they can do is they can find a British multinational company with a mirror image financing need in the US, right? They may both benefit from a swap. If the spot exchange rate is 1.6, the US firm needs to find a British firm wanting to finance a dollar borrowing amounting to $16 million, right? The easiest way to hedge the risk is to find a British firm which is having a $16 million borrowing requirement in US. Consider two firms, A and B. A is a US-based multinational firm. B is UK-based multinational. Both firms wish to finance a project in each other's current country of the same size. Their borrowing opportunities are given in this table. Right? A can borrow dollars at 8%, pounds at 11.6%. B can borrow dollars at 10%, pounds at 12%. So they go to a bank. A's net position is to borrow at, let's say how it works out. A is originally borrowing dollars at 8%. Right? They borrow $16 million, which bank pays 8% dollars that they are giving. Right? And firm B is paying 12% on 10 million pounds, right? So A has borrowed 16 million pounds at 8%. B has borrowed 10 million pounds. A has borrowed $10 million, $16 million at 8%. B has borrowed 10 million pounds at 12%. Now, B is also giving the 10 million pounds to SwapBank, and they receive 12% sterling interest, right? So what the SwapBank does is they take $16 million from A and give it to B, and they take the 10 million pounds from B and give it to A, right? So on 10 million pounds, A has to pay 11% interest to SwapBank, and on $16 million, B has to pay 9.4% interest to SwapBank. So effectively, if you compare with the borrowing sheet, there's a saving for both banks. But remember, in this case, there is exchange rate risk because you are switching from one currency to another, right? All parties are carrying exchange rate risk. Right, risk of interest rates and currency swaps, there is interest rate risk. Interest rates might move against the swap bank after it has only gotten half of the swap on the books, right? So interest rates might turn against you. Now you're getting dollars, they're borrowing at 8%, but the interest rate might drop. And likewise, sterling, they're lending at 11%, but interest rates might go up. So there's interest rate risk. Basis risk, if the floating rate of the two counterparties are not pegged to some index, right? So if you are not perfectly hedged, there is always basis risk. Exchange rate risk, in the example of currency swap given earlier, the swap bank would be worse off if the pound appreciates. That because their net payment is probably coming in pounds, right? So there is a liability in pounds. If the pound increases in value, they will lose. Credit risk, the risk of default. This is the major risk faced by a swap dealer. The risk that a counterparty will default on its end of the swap. Mismatch risk, basis risk, which we discussed earlier, and sovereign risk, right? The risk of a country default. The forward rate agreements, right? I'll explain using an example. Forward rate agreements. Let's say your bank is giving 1 year personal loans, right, at a rate of 10%. 2 year personal loans at a rate of 12%. And if a customer comes to you and he says he wants to borrow for 1 year, not today, but 1 year from today, right? So he will start the loan 1 year from today and wants to continue it for 1 year. He wants the rate today. He will do that because he expects interest rates to go up in the future, right? That's why he wants to fix the interest rate today itself. Now, what rate will you quote to this guy? The theory is, let's say this is a 2 year loan. Let us say the first year you're lending at 10%. No? So it's convenience sake, let's say, take the amount as 10 million rupees. On 10 million rupees, first year you will get interest of 10%. Then the second year, or let's say lending at a rate of R. And right, so that's what you get when you lend 10 million for 2 years. Now, for this to be equivalent, right, your 2 year lending rate should come to the 10 million. Squared. Means ten million cancels off and R comes to around 14%. This is called the forward rate. It means the rate that will prevail 1 year from today for a period of 1 year, right? So this loan starts 1 year from today, and it continues 2 years from today. It's called a 1/2 FRA, right? The borrower is long, and the bank is short. That's how FRAs work. Okay, so it's something like this. This is the structure. Now, it need not be years, it can also be months or weeks. So this is a 3 against, this illustration is a 3 against 6 FRA, which means it starts 3 months from today and continues up to 6 months from today, right? So it's a 3/6 FRA. FRA is a contract in which the underlying rate is simply an interest payment, not a bond, or a time deposit made in dollars. You borrow any other currency that at rate that is appropriate for that currency. Forward rate agreement is a forward contract on a short-term interest rate, usually LIBOR, in which cash flow obligations at maturity are calculated on a notional amount and based on the difference between a predetermined forward rate and the market rate prevailing on that rate, right? So that means if, for example, in the previous example, if the market rate, 1 year lending rate on in 1 year's time, right, goes up to 15%, then this borrower will gain because he has agreed to borrow at 14%. But if it drops to, say, 10%, he will lose, right? So depending on where interest rates are heading, you can either gain or lose. That's how FRAs work. Settlement date of an FRA is the date on which cash flow obligations are determined. The structure is the same for all currencies. FRAs mature in a certain number of days and are based on a rate that applies to an instrument maturing a certain number of days, measured from the maturity date of the FRA. The short party or dealer and the long party or end user will agree on the interest rate at a time interval and a hypothetical contract amount. The end user benefits if interest rates increases, right? The borrower benefit if interest rates go up. He has locked in at a lower rate with the dealer because the end user is long, the dealer must be short, and interest rates will benefit if, and the short must be short, the interest rate, and will benefit if interest rates drop. The contract covers a notional amount, but only interest payments on that amount are considered. It is important to note that even though FRAs may settle in a fewer days than the underlying rate, there is a number of days to maturity in the underlying instrument. The rate that the dealer quotes has to be evaluated in relation to the underlying rate because there are 2-day figures in the quotes. Participants have come up with a system of quotes such as 3/9, which means the contract expires in 3 months and in 6 months or the 9 months from the formation of the contract. Interest will be paid on the underlying euro-dollar time deposit upon which the contract rate is based. Other examples include 1/3 with the contract expiring in 1 month based on 60-day LIBOR, or 6/12, which means the contract expires 6 months based on the underlying rate of a 180-day LIBOR, right? 180 days is 6 months. 6/12 means it starts 6 months from today and is based on the 180-day or the 6-month LIBOR, usually based on exact months such as 30-day LIBOR or 60-day LIBOR and not odd days. Usually you don't get it like 37, 134 days. If a client wants to tailor an FRA, it is likely that the dealer will do it for the client. You can tailor make, it can be offered as tailor-made product. When this offers, it is considered to be off-the-run contract, right? Off the run. It's called an off-the-run. Remember the term. So this is how we calculate the profit on a FRA. Right? It's the difference between the rates, the rate expiry minus the contract rate, right? So if the rate is 15% and you agreed at 14%, you will gain into the number of days divided by the one plus the rate at expiry. Okay, that's where you discount it. Sorry, there's a small mistake. Oh, sorry, this is correct. Okay, that's fine. Yeah, I got confused with the brackets. That is fine. The numerator, the contract pays the difference between the actual rate that exists in the marketplace at expiry. Denominator when is where you discount. The profit is coming in the future, which you need to discount. Denominator, when rates are quoted in the market, they are based on the assumption that they will accrue interest and payment that will occur in the future. Discounted payment at current LIBOR does the adjustment. So let's do this example. Dealer quotes a rate of 4% on this instrument, and the user agrees. He is hoping that interest rates will increase, right? So he agrees to 4% because he expects interest rates to go up. Expiry is in 90 days. The notional amount is 5 million. The underlying interest rate is 180-day LIBOR time deposit. Right? In 90 days, the 180-day LIBOR is set at 5%. Interest rates will be paid 180 days later. Right? Let's again do it on an Excel sheet. Profit B says the 180-day LIBOR is at 5% when it matures. Minus 4%. We get the benefit for half a year. And you discount it, remember the market rate. 1 plus 5% into the number of days. Right. Is 180 days or 360. Amount is $5 million. Right, so please correct this answer in this answer this question. With the rate increase, the long party will receive 47,600 from the short party. Right, that means the customer will get $47,600 from the bank. If the rates were to decrease, the long party would have to pay the difference between the quoted rate and the 180-day LIBOR rate. All right, so that's it on futures, swaps, and FRAs. Right, next week we will do options, and with that we will conclude derivatives. Okay, so thank you very much. I will see you all next week through a live session. Thank you. Have a great week and stay safe.